Chris, what's up? Good morning.
Good.
Yeah, dude, what'd you think about over the weekend? What's your reaction to everything we're seeing right now?
Um, you know, this is where I have to say I'm not surprised at all. I think this is all kind of it definitely this is going to sound like a conspiracy, but whatever. But Trump is basically screwing the markets. All right, he wants the markets to come down significantly before he comes into office. And I mean, to me, it seems like an obvious thing what he's doing. He's showing a lot of, how do I say, a lot of fear into the markets. I mean, why else would you, like a month and a half, 2 months ahead of inauguration, start with, I'm going to put a tariff on Mexico. I'm going to put a tariff on Canada, our two largest trading partners. I'm going to go after Greenland. I'm going to force the Europeans to buy more oil and natural gas. It's just everything that he says is very, very inflationary. And so I think the market is front running a lot of the stuff that he's saying, and we're feeling the consequences of it. This way, when he does take office, he can pretty much just say, hey, look, Sleepy Joe was sleepy at the wheel, and now the markets are crashing and blah, blah, blah. So this way, all he has to do at that point is just be a lot less, how do I say it, a lot less punitive when it comes to Canada and Mexico, a lot less punitive when it comes to other things. And now the markets will be like, oh my God, maybe it's not so bad after all.
Essentially, what you're saying is like sort of basic human psychology. It's really hard to just keep going up. Trump knows this. He's a business guy. He knows stocks just don't keep going up forever. He even said that to Jim Cramer, right, when they were talking on the floor of the stock exchange. And he said, yeah, well, maybe we'll get some dips. And so you're saying he's doing some stuff to potentially get some market volatility in so that if we do have a 10% correction, it's much easier to have a 10% rebound. And then he gets all the credit for the 10% rebound. But no one's going to give him that much of the blame because if the market's at an all-time high, everyone expects a 10% correction anyway, right?
Pretty much. You want to start from, this is like a basic negotiating thing where you want to start at a lower point than something really high, because it's really hard to come in and try to like outdo an already a market that's already on fire. And then you also have the Biden administration counteracting that by spending as much money as they can as they leave, so that this way they don't get put in a position where they're taking in a lot of blame, where they can say, look, we created the most jobs of any president, in the last 50 years. So a lot of this is politics, and we're paying the consequences of it, basically. I think that one of the key things that everyone here hopefully remembers is don't follow what they say, follow what they need to get their agenda accomplished, right? So Trump's agenda is lowering trade deficits across the board. Now, how do you do that? You can't do that with a strong dollar. Okay, you basically are making imports cheaper and exports more expensive for the United States. So what do you need? You need a weak dollar. What do you need to get to a weak dollar? You need us to lower interest rates lower than what the other guys are lowering their interest rates at. So one of the things that we're seeing is the strong dollar is having this negative impact where all these countries, because of commodity price inflation, what they're doing essentially is selling U.S. treasuries to support their local currencies. Now, as they sell that off, what you're seeing is this kind of like this perverse loop happen where basically as people are selling off their foreign exchange reserves, they're increasing, the supply of treasuries, but at the same time, the dollar keeps going up. And then now there's another thing that's happening, which I'm not sure you're aware of, or anyone in the market is really aware of, but you're going to see hedge funds use something called pretty much a carry trade, where right now you can go to the Federal Reserve and actually get something called a reverse repo, which you can pledge your treasury securities and get and basically borrow more money so you can buy more treasuries. The thing is, the cost to borrow is only like 4.25,
Yeah.
and the 10-year right now, the yield on it is like 4 point almost 8. So you're getting this huge, no, it's not super huge, but you're getting the spread that's available to you. And the one thing that happened in December, which kind of went a little bit unnoticed, is that the 4.5 to 4.25. So even though the 10-year seems like it's going nothing but parabolic up, I do feel like there is a cap, because as the 10-year goes higher and higher, it's more likely that you're going to see a lot of hedge funds buying the 10-year and then applying this carry trade at the same time.
What's the benefit to them doing the reverse repo exactly?
Imagine right now I tell you, hey, Amit, I will lend you money at 4.25, okay? But I need collateral.
Yeah.
So you say, okay, no problem. Here's collateral. Here's my 10-year treasury that pays 4.75.
Right.
You take this as collateral, and I will now end up taking that money, right?
At 4.2.
Basically that I have, because I'm the Fed, and I give it to you in the form of cash. So what do? You go out there and you buy more 10-year treasury, and then next time you pledge more collateral again, right?
Right.
And I give you more money. So it's basically this loop that happens where you're basically you're letting me borrow money at a cheaper rate than the asset that you're basically buying that has a higher yield. And that yield difference is where you're making basically risk-free money.
Right. What are the implications of that on the market? You think that just means that there's less liquidity to an extent?
To me, it means that there is ultimately a cap in how much rates can really go higher.
Right.
I think the data points that are coming out right now are very bearish, and the inflation expectations are really high. But that's mainly because some of the data that we're seeing that's coming out of like the BLS and stuff, maybe, I don't even know how to say it, but basically, stoking fears into the market rather than reality. So right now, we really still don't know what's going to happen when Trump comes to office. I know a lot of people are already like, oh, Trump's going to come in and he's going to do that, he's going to do this. So I think a lot of people in the market, they can't trust who this guy is or what he's going to do. So one of the things that you're seeing is a lot of people front loading on inventories, buying things before he comes into office, because why would you wait? Why would you wait to import all this stuff? Trump comes in, slaps a 25% tariff on on outside good from let's say China. You're going to order your stuff now. So what we're seeing is, in the short term, you're going to see higher CPI. You're going to see all these data points that are showing that inflation is reaccelerating. In my opinion, look against that. Like, ignore the noise. Find out when Trump is actually in office and what his policies are going to be like in the next couple of weeks, and see if his tone goes from being like uber, like I'm gonna go this, I'm gonna do this, to more like a moderating pace. Because if he ends up being more moderate, you're gonna see the markets reverse. And in which case, you kind of want to be in yield assets like TLT and other things. So a lot of great companies right now that are kind of like not as impacted by the economy, their yields have gone to like 7-8% almost right now. So those companies, their stock prices are going to go much higher if we end up getting a reversal on the interest rate. I mean, the inflation expectations.
So you think CPI is going to be hot, but all of its noise until Trump gets into office and actually begins the types of policies that can take inflation down, or at least get the bond market to cool off a bit.
Yeah, I mean, you saw this with Trump 1 when he first came in. Like, he jawboned his way into getting Fed to lower rates. A lot of the policies that he wants to implement require a weak U.S. dollar. Like, he needs a weak U.S. dollar. Okay, like you just, all the stuff that he's trying to get done, he's not going to be able to get it done with a strong U.S. dollar. It's just not. So the assumption that we have to make is one where the dollar weakens considerably. And now that the dollar is so strong, he can actually go to some of these countries and negotiate a little bit unfairly in the advantage of the U.S. So I don't know how he's going to pull everything off. But in my opinion, there are some other market forces that are out there that are going to really push inflation down this year, that are like almost like an unstoppable freight train. But a lot of people right now, they're looking at the current information, and they think that the Fed is done cutting. And to some people, there's even a chance that hikes happen. And I'm like, yeah, bullshit, dude. That's not.
You think there's no chance we're gonna get a hike?
No, because then the dollar would get even stronger, man, and then it would mess things up royally for everyone. There's already a ton of companies out there that are teetering on bankruptcy because the capital markets right now are misaligned with their business models. So it's one of those things that, like, it's a catch-22 right now. So the Fed, the longer it keeps rates high, the more of a chance that they're going to actually cause a recession, you know? Ultimately, we are going to get a recession because recessions are, part of the economic cycle. That's just how things are. But you don't want to make it so obvious that you want to crash the market and to crash the economy. I think the one area that they should really, really 100% focus on is shelter. And the core component of shelter is owner's equivalent rent, because that is on a downward move, and I'm seeing inventory pop up everywhere. So one of the things is December, usually there's like a good amount of housing that comes off the market. But this year, you didn't see nearly the amount of homes coming off the market, and you're starting to see inventories in certain parts of the country grow. So that is going to eventually lead to lower rate of growth in real estate, and possibly even somewhat of a downturn. And if we do get a downturn in real estate, like maybe 4 or 5, maybe 10% correction in real estate, that causes almost like a reverse wealth effect.
Yeah.
And now that makes people stop spending as much money, cut back on spending. And if people cut back on spending, now you've got lower growth. And if you got lower growth, you've got lower inflation expectations. And if it becomes too serious, then you got yourself deflation, which is what China's going through right now, because they have a giant property bubble that basically burst on them. And now they're trying to get back into growth mode, and no amount of stimulus is working. Granted, they have a much larger problem than we do right now, but I think all the policies that I'm seeing are leading me to believe we're likely to get into a more disinflationary and possibly even deflationary scenario by the end of this year. And the way that we should be positioning ourselves is against the tide. Don't follow the current narrative that inflation is going to go nothing but up from now on. That was the mistake that was made in October of 23. That was the mistake that was made in May of 24. And then kind of in August of 2020. Well, not really in August, because that was the carry trade blowing up. But those two times were the ultimately the ones that are the best examples of how the narrative can shift on you very quickly. And if you're smart, you can make a ton of money.
I think that's a very good point. And I think it is, the fact that Bank of America says we're done with cuts, to me is like, okay. So it's a little bit reactionary towards some of these inflation expectations. And maybe that mainstream narrative isn't going to be the case. Couple questions, Chris, from the chat. Dylan says, is Home Depot a play if people aren't buying homes, but they're upgrading their homes?
Not necessarily. I don't know how it's going to impact their business model, because their major customers are usually contractors. And the thing is, if people are not moving as much, maybe that there's more likelihood that you will see, you'll see people buying supplies to repair. But I don't know how it's going to impact them. I do know, however, that if you look at the report from who was it? The housing makers. Do you have your Fred open up right now? Go to Google, type in Fred, Fred.
Yeah, I got that.
And then go to single family housing inventory.
Okay. Housing inventory.
Or just type this in: new one family homes for sale in the United States.
I think this is the correct chart. Let's see. Existing single-family home sales.
No, not that. Put
Others.
in a new one-family homes for sale in the United States.
Okay. New one-family homes for sale. Okay, I got it.
Okay, now look at that chart.
Wow,
You see that?
it's going up.
So there's a lot of inventory that's kind of coming around and sitting around. And then when you add in kind of like a lot of other housing, like existing inventory, and a really, really slow sales cycle right now, you're seeing almost like an inventory buildup. And that inventory buildup is going to put a lot of downward pressure on price appreciation. And as price appreciation starts to come down, you're going to see owner's equivalent rent start to come down. So look at Fred and look at owner's equivalent rent. OER. So just type in OER Fred.
Yeah, put that up. We are at 418.2 November.
Okay, what you're looking at right there is just the index. But if you go to the graph, right, and you go to like that little green button, that red button says edit graph, and then you go to, instead of index, just put change from a year ago, or percentage change from a year ago.
Okay. There we go.
Okay. So now do you see that sharp drop?
Yeah.
That's the thing to pay attention to. Because that means that owner's equivalent rent, which is what the Fed uses to survey people, you can see that expectations are coming down significantly on what people are likely to pay in the future for rent, right? So a lot of this data is it's lagging data. So this is like the freight train that we have to be careful of, because if this keeps going in that singular direction and it doesn't stop at a certain point, what you're going to see is inflation, the numbers are going to actually come down significantly. Because one of the things that's holding up inflation right now, or making it quote unquote sticky, is the rate of deceleration in owner's equivalent rent. As a part of CPI.
So essentially, new homes supply is going up, but rent's coming down, and that is a recipe for shelter inflation to come down. That's your point.
Yeah, correct. So going forward, I'm telling you, there are certain parts of the country right now that there's a huge correction already underway. I mean, you look at Tennessee, Florida, and Texas, and I think like some of the other southern states that had the biggest booms during the COVID era.
Right.
A lot of places are having pre-COVID level inventories and actually deceleration in prices. And I think median prices are actually declining compared to what they were even in 2022. So
when do you think this data makes its way into the Fed's data dependency handbook? Like, when do they actually see it?
It lags about 11 to 12 months usually, but between 10 and 12 months depending. But yeah, that's the thing right now. So if you're looking at this data and it's saying 4.9%, which is what the thing is, I would say at this law, if you look at this scaled out, I think we're looking at probably like a 2% or less in 2026. I think a lot of the impacts are going to be felt in 2026, that deflationary pressure.
Dude, in 2021, we were at 2%.
Say that again?
In 2021, we were at 2%. In 2023, we were at 8%.
Yeah.
So it is
and
coming down.
You can see that usually, like prior to COVID, it was running about 3% on average.
Yeah.
For quite some time. But that was under a ZIRP regime. Okay, so zero interest rate policy. Imagine how much is going to come down during a 7-8% 30-year mortgage. I mean, there's not a lot of people that are going to be able to take on a 30-year mortgage with a 7.5-8% mortgage, with all-time highs in pricing of homes, even if the inventory is not as big as it is. The other challenge is the transfer of wealth from boomers to the younger people. So you've got boomers who basically have a ton of excess savings, paid off houses, and then at the other end, the people that are more likely to buy those homes are people that are some of the most indebted people on in the history of the U.S. With student loans and all this additional liabilities. So this is a very, very curious thing. And then there's one last data point that we should probably look at, and that's the growth of the United States, like the total population.
I think we're at.
So if you go to just Google, type in total population of the U.S., one of the things that you're going to see is that since COVID, we've actually gone down significantly in terms of our total growth rate.
You're right.
The only reason why we've had positive, somewhat positive growth, like 0.5%, 0.0, basically half a percentage point in population growth, is because of all the immigration, right? If it wasn't for immigration, we would have been in a much, much weaker state. And from what I can tell, demographics are not exactly in our favor, which pretty much means that if Trump were to go ahead with his, stronger border policies, you're going to see, number one, you're going to see people leaving the country, which is just how things are. But then you're also going to see a lot less entries, which means the total population growth is likely to decelerate significantly. And Japan and China basically have proven to us lower population equals lower growth equals lower inflation and possibly deflation, So if you look 5 years ahead, or if you're looking at a population change that's, no population change or actually negative population change, hopefully not negative, but let's say no population change, what you're essentially doing is the population of the United States, the existing population, is going to be aging.
Yeah.
Right?
Yeah.
And so now, where's the growth going to be coming from? The only way you're going to do it is by productivity gains via something like AI.
Correct.
And if you think about it, all of that stuff is super deflationary. Like, people are forgetting that technology, one of the reasons why we've enjoyed such low inflation for the last 20 years is because technology has revolutionized things. So technology is very deflationary. So if I were to position myself going forward, I'd say be counter to what a lot of these people are saying in the open market. All they're doing is stoking the fears of inflation, but I think we're going to see the opposite. I think the country needs a lot less. We need a weaker dollar, but we also need lower interest rates. Otherwise, our federal deficits are going to keep growing also. So that's another thing. That's another benefit that Trump can actually get, is if he's able to lower the inflation rate down significantly and decrease the interest rates, that means that he can close the deficit as well.
Chris, first of all, this is fantastic analysis. I think it makes a lot of sense, and it creates a foundational understanding of where deflation is going to come from. Do you have any conviction still in the Trump Bitcoin thesis? And do you think day one, we get a surge from a reserve or a press release or executive order? What do you think?
Some people are saying that that's the way that he's going to weaken the dollar. I mean,
explain.
I don't know.
Explain. What do you mean?
I mean, if you're basically going out there selling US dollars and buying Bitcoin, that's going to strengthen Bitcoin, but at the same time weaken the US dollar.
Yeah.
Right?
Theoretically.
So that's one of the theories that's out there. I'm not sure. I'm not so sure how that dynamic even works, to be honest with you.
Dude, but that would be super cool, right? If the way to get the dollar to come down is to go long Bitcoin, because then all the Bitcoin people are happy, and then everyone who's invested in stocks are happy, right? Because the dollar comes down. I mean, that would be kind of cool if that's how it plays out.
Like I said, I'm hearing the thesis, but I don't know how it works mathematically, so I can't really comment on that. So
yeah, I also think you would have to buy a lot of Bitcoin to make that play out.
Yeah. The one thing I'll say is the expectations right now that the Fed has, that they're only going to cut one time, I think is complete bullshit. I think we're probably going to get 4 cuts this year.
Well, look, you've been very outspoken on this idea that you think we're getting more cuts, and right now the market doesn't agree with you. But I think, but in 2024, the market also got super bullish for cuts, and we didn't get them for 9 months. So the market's been wrong on cut expectations for the past 2 years, basically.
Yep.
Okay, last question for you.
That's how you're supposed to invest. You're supposed to invest
Agreed.
counter to what the market is telling you, because that's the only way you get a deal and you're making money. I'm telling you, there's a lot of great companies out there right now.
So that was gonna be my last question. What is a screaming buy? Do you think there's any screaming buys right now to you?
Not in particular. The one that I've been looking at, and it's one that I made money on last year, is Verizon. You look at Verizon right now. Verizon's trading. What is it today? VZ stuff. Let me see. It's up a little bit today, but it's trading at $38. It's got a 7% dividend payment right now, which is a qualified dividend. A PE ratio of 16. Yeah, they don't have as much growth, but their cash flows are really good. And if we do get cuts, we're likely to see this thing go higher, right? Because now people are going to be chasing the yield, and it's safe. The other mechanism that's really good is that, let's say we do get a recession. Once again, Verizon is like a pseudo utility, right? Because the last thing you're going to do is who's going to cancel their cell phone plans because they lost their job? Yeah. Very few people. They're going to say, no, I'm fine. I'll keep this shit around, right? So that's one of the last things you're going to cut. So in which case now Verizon is going to get yield chasing, but then at the same time, a whole bunch of people jumping in for safety reasons because they're like, I don't want to be in growth. I want to be in value.
Verizon's giving a 7% yield right now. It's not horrible.
Yeah.
Not horrible at all.
Yeah. Most of their debt is really far out debt. And their expenses are actually getting a lot more tamed because most of the spending that they did over the last few years have been basically on spectrum acquisition, which now the acquisitions are complete. So now they don't need as much spectrum. So now they actually can focus their additional free cash flow on debt reduction, so it's just value accretive to investors.
Chris, last thing for you. All the quantum names are down upwards of 25 to 30% right now. Do you think these things go to zero? Or, these are now down almost 75% from the high. How do you think this plays out?
The challenge with a lot of these quantum names is just what Zuck and Jensen said. They're too far out, which means right now they're going to be burning capital. Now, where are they going to go for that money? Well, there's two ways companies can raise money, and neither one is value accretive to shareholders. One is by issuing more shares, right, to survive. That's one way. And the other way is by taking on debt, which right now at the current rates that you're going to be taking on debt, it's going to be like too high to maintain any sort of profitability. The thing is they don't have any products in the market, so I don't even know how these guys are making any money whatsoever. So I'd say be careful with these, with the quantum computing names. A lot of it was just hopium that was fed into the market by people. And, like the Google breakthrough definitely was a technological breakthrough, but it wasn't like, okay, it's a new business model that can be monetized anytime soon. So that's the way I see it anyway. So right. I don't know. I'm not in quantum. The one mistake that I would say is I didn't short it. I have a really bad track record when it comes to trying to short companies. And I haven't done very well. Like my recent shorting failure has actually been PayPal. Like after the whole honey thing, I was like, yeah, let me buy some puts on PayPal. And that shit did not work out. And so I sold out of it. And then the fucking thing kept going down. I was like, God damn it. Like, what the F, dude? Like the one time I actually have a decent confidence interval and something going down and it does start going down, I end up losing. So I was like, I don't know what it is, bro. Maybe I'm just bad. I just don't have luck when it comes to shorting.
Well, you have to have a consistent thesis, and when the stock goes against you, it's hard when you're short, right? It's like,
no, you need to have balls. I don't have the balls for it. Like I will come up with a great thesis on why something should happen. I can be bullish on the long side, but the amount of risk that you're taking trying to short and going the other way it's too much for me. So I don't have the balls to short, and I should probably just stay away. If anything, the way I should position myself is if I think something is going to go down, I shouldn't short it. I should just stay out of it. That's it.
Yeah, it's fair. Yeah. All right, Chris, your Twitter in the chat. Everyone really enjoyed your analysis here today, so everyone can follow him there on Twitter, and we'll talk to you soon.
All right. Take care, guys.
Take care.